Iron Financial, the place where we forge stronger portfolios by stress testing the market narratives that everyone else just accepts at face value. Today, we are putting Hilton Worldwide right under the microscope. Their latest Q4 2025 earnings report just dropped, and believe me, in a market this shaky, these numbers aren't just a report card. They are a critical test of the company's entire structural integrity. So our job today is to figure out if Hilton is really building a financial fortress, something designed to withstand any economic storm, or if that impressive exterior is just a facade, hiding some really serious cracks. Let's get into it.
Yeah, hold on. Before we get all swept up in the grand long-term vision, let's just be real about what's sitting right in front of us. Because on the surface, these numbers are, well, they're not exactly inspiring, are they? We're seeing some definite weakness in key areas, and I mean really key areas, especially their home market, right here in the US. So the most immediate, the most pressing question that any investor has to be asking is this. Has the market just gotten way ahead of itself here? Has everyone just completely overvalued Hilton's supposed resilience while totally ignoring these clear warning signs that its core business is actually slowing down? So is this fortress really as strong as they say it is? Honestly, I've got my doubts.
All right, to get to the truth, we've laid out a very clear blueprint for our analysis today. First, we're going to dig into those immediate headwinds, what we're calling Hilton's surface-level cracks. Then, we're going to look at the heavy machinery that's been working behind the scenes on forging future growth. After that, we drill right down into the financial fortress, the cash-generating engine of this whole thing. Then, we're going to put it all to the test in stress testing the bull case. From there, we'll analyze management's own plan, which they're calling the 2026 blueprint. And finally, after all of that, we will deliver the iron verdict. That's exactly right. Before we buy into one bit of hype about development pipelines and flashy new brands, we have got to look at the facts on the ground. We have to start with the cracks that actually showed up in this fourth quarter. These are the numbers that tell us what is happening right now, not in some far-off hypothetical future. And frankly, they paint a picture of a company that is facing some very, very real pressure. Let's not mince words here. The top-line performance is just weak. Okay, let's start with the big one, the headline metric for any hotel operator, revenue per available room, or what we all call RevPAR. So what was the growth? A measly 0.5%, 0.5. Now, for a premium global hospitality giant like Hilton, a number this low is a serious problem. To give you some context, in this kind of economic environment, analysts are looking for RevPAR growth that at least, and I mean at least, outpaces inflation. You want to see something in the 2 to 3% range just to feel comfortable. 0.5% isn't just treading water, it is barely keeping its head above water. If you adjust for inflation in real terms, they're actually going backward. This is the first and maybe the most obvious surface-level crack. And it actually gets worse when you dig into their single most important market. A 1% decline, that's a negative number. A 1% decline in US RevPAR. Look, this isn't some tiny emerging market with a bit of political instability. This is their home turf. This is the engine room of their entire global operation. This is where they generate the vast bulk of their high-margin fees. So when your core market is actively contracting, you have to start asking some really tough questions about the health of the entire structure. Management can point to international strength all day long, but a decline here is a massive red flag that you just cannot ignore. And here's where it gets really crucial. The weakness is concentrated in one of the highest margin segments you can find, the individual business traveler, down over 2%. Now, management can try to blame the government shutdown and softer government demand, but that excuse starts to wear pretty thin when you look at the broader trend. What this really makes you question is the overall health of the entire corporate travel recovery. Is it starting to falter? Is that high-spending road warrior finally starting to pull back on the budget? Because if that trend continues, it hits the bottom line way, way harder than a drop in leisure travel. These aren't just minor blemishes, folks. These look like foundational cracks. Okay, hold on. Focusing only on quarterly RevPAR is like judging a brand new skyscraper by a few hairline cracks you see in the sidewalk. It is incredibly short-sighted. Yes, the top-line numbers were soft. Nobody here is debating that. But the real story, the one that actually builds long-term value for shareholders, isn't about the paint job. It is about the steel foundation that's being laid. While you're sitting here staring at the cracks, Hilton is doing the heavy lifting behind the scenes, forging an engine for future growth that completely, and I mean completely, dwarfs these short-term headwinds. The true scope of Hilton's strategy here is all about empire building. Their growth engine is not just about filling the hotel rooms they already have. It is about a massive, strategic expansion of its entire brand portfolio. This is a direct response to some fundamental shifts in how people travel and work now,
I mean, they're pushing into new white space with ventures like the Apartment Collection, which is aimed directly at the booming extended stay market that's being fueled by remote work and these bleisure trips. They're also launching collection brands like Outset to attract independent hotel owners, tapping into the traveler who is, frankly, tired of cookie-cutter hotels and wants a unique local experience. And the best part? Hilton gets to collect fees on all these properties without spending a single dime on bricks and mortar. It's a brilliant asset-light power move.
And here is the hard data to back all of that up. 6.7% net unit growth for the full year. This is an all-time record for the company. They added nearly 100,000 new rooms to their system in 2025 alone. That was their biggest year of organic openings ever. This is not a company that's slowing down. This is a company that is accelerating its physical footprint across the entire globe at an absolutely unprecedented rate. And remember, every single new room is a future source of high-margin recurring fee revenue. This is the heavy lifting that builds durable, long-term value.
Now, let's break down how they're pulling off this record growth, because this part is really key. Roughly 40% of their new rooms last year came from what they call conversions. So think about what that really means. These are existing hotels, owned by independent operators, who are making a conscious, hard-nosed financial decision to take down their old sign and raise the Hilton flag. They are actively choosing to pay fees to join Hilton's system because they believe its global distribution network, its loyalty program, and its brand recognition will make them more money, period. This is a powerful, real-world vote of confidence in the sheer strength of Hilton's commercial engine.
And this growth isn't stopping anytime soon. In fact, it's just getting started. This number right here. This is the single most important forward-looking indicator you need to know. Over 500,000 rooms in their development pipeline. That is yet another company record. This isn't a hope or a dream. This is a clear, long-term, contractually backed blueprint for sustained growth for years and years to come. To put this in perspective, Hilton themselves stated that 1 out of every 5 hotel rooms currently under construction anywhere in the world is slated to become a Hilton property. That is market dominance in the making. So, we've seen the growth engine. It's massive, but growth is totally useless if it doesn't translate into real financial strength. And this brings us to the very core of the bull case, the financial fortress. This is where we analyze the company's cash-generating engine. And what the numbers show us is that even with that soft RevPAR we talked about earlier, Hilton's capital-light business model is an absolute fortress, specifically designed to churn out immense and growing cash flow, regardless of minor turbulence in the top-line numbers.
Let's drill into these numbers. Adjusted EBITDA was up a very strong 10% year-over-year to $946 million. The management and franchise fees, which are the absolute lifeblood of their capital-light model, grew by a very healthy 7.4%. This brilliantly illustrates that even when RevPAR is nearly flat, the simple addition of thousands of new fee-generating rooms and disciplined cost control can drive significant bottom-line growth. Now, I know the first thing a sharp analyst is going to spot is that big red number down at the bottom, net income down a whopping 41%. It's a huge drop, and you absolutely cannot ignore it. That's right, a 10% jump in EBITDA looks fantastic until your eyes drift down and you see a 41% drop in net income. It suggests there are other pressures bubbling up under the surface, maybe from higher interest expenses or some other items that this adjusted EBITDA conveniently ignores. You can't build a fortress on adjustments alone. To me, it looks like a classic case of financial engineering to make the operations look a lot healthier than the actual bottom line.
And that is a perfectly fair point to raise, and it's exactly why we stress test these numbers. But management's focus, and I believe the market's focus, is really on the core operational cash flow, which in this asset-light model is best represented by EBITDA. The CEO, Chris Nassetta, he said it himself on the call. He highlighted this very performance as, and I quote, demonstrating the power of our capital-light business model. The whole strategy is explicitly designed to divorce the bottom-line performance from the capital intensity and the volatility of actually owning the hotels. The fees are what matter, and the fees are growing strong. And here is the ultimate proof of that financial strength. $3.3 billion. That is the amount of capital Hilton returned directly to shareholders in 2025 through buybacks and dividends. That is the highest amount in the company's entire history. So the crucial point is this. A company with genuine foundational issues, a company that is worried about its future cash flow, does not turn around and hand a record-breaking amount of cash back to its investors. This action speaks so much louder than any single RevPAR number. It is a massive signal of management's supreme confidence in the durability of their financial fortress. Okay, I'll concede that capital return is impressive, it's a big number, but that doesn't mean we just give them a free pass. We have to stress test this bull case. A good analyst always pushes back, and I see several potential weak points here. The growth numbers are strong, I get it, but what if they're a facade? What if they're built on the back of really volatile international markets, specifically to hide the significant problems that are brewing back home in the United States? It's a classic case of misdirection, you know? Look over here, and we need to dig deeper. What other risks are being glossed over?
So here is the entire debate in a nutshell. The bull case points to these phenomenal international numbers. You've got RevPAR up over 5% in Europe, almost 16% in the Middle East and Africa, over 9% in Asia Pacific. I mean, those are monster numbers. But are they a sign of a brilliant global expansion strategy, or are they just a convenient distraction from a U.S. market that is in decline? And let's be crystal clear about something. $1 of revenue in the U.S. is often worth way more to the bottom line than $1 in some of these emerging markets. You cannot just paper over the cracks in your most profitable region with high-growth, lower-margin international wins. So are they just plugging holes in the dam?
And let's keep this stress test going. We hear all this excitement about the new brands. You know, they sound innovative, they sound cool, but are these really niche concepts that are truly scalable growth drivers for a $75 billion behemoth? Or are they just, fodder for a press release? And beyond that, what about the external threats? That incredible 16% RevPAR growth in the Middle East, that could evaporate overnight if regional tensions flare up. And we haven't even mentioned the ever-present competition from Airbnb and other alternative lodging platforms. Is Hilton's traditional hotel model really insulated from that constant pressure? We need proof, not just promises. Those are exactly the right questions to be asking, and honestly, the best way to address those concerns is to look at the official blueprint that management themselves has laid out for the year ahead. They're not hiding from the current environment. Instead, they've provided really detailed guidance for 2026. This isn't just some vague forecast. This is their strategic plan for navigating these exact challenges and capitalizing on their strengths. So let's see what the architects of this supposed fortress are actually planning to build. Okay, let's walk through this blueprint step by step. First, they're projecting system-wide RevPAR growth to re-accelerate to between 1% and 2%. It's modest for sure, but it's a return to positive growth. Second, they see Adjusted EBITDA crossing the $4 billion mark for the first time. Third, and this is absolutely critical, they expect to sustain that record pace of net unit growth, guiding for another 6 to 7% expansion in 2026. And finally, just look at step 4. They plan to return approximately $3.5 billion to shareholders. That is even more than the record they just set in 2025. This is not a company that's retrenching. This is a company that's pressing its advantage. And this guidance is backed by a very, very optimistic outlook from the CEO. On the earnings call, Chris Nassetta was perfectly clear. He expects 2026 to be stronger than 2025. He believes that macro forces, things like falling inflation and the prospect of lower interest rates, are all creating a positive convergence for their business. He also points to tailwinds from big global events like the World Cup. Now, of course, that is the view from the C-suite. They're paid to be optimistic. But you have to ask, what if that positive convergence doesn't actually happen? What if REITs stay higher for longer? Or what if a global slowdown hits those very international markets that are propping up the numbers right now? The blueprint looks good on paper, no doubt, but it does assume a fairly smooth ride ahead. All right, we have examined the surface-level cracks. We have analyzed the machinery that is forging future growth. We have inspected the financial fortress, and we have stress-tested the bull case from every angle. We've even reviewed management's own blueprint for the future. After putting all of these components through the iron financial gauntlet, it is time for us to deliver our final verdict. Is Hilton an opportunity for investors to build lasting wealth, or is it a value trap that's just waiting to spring? The iron verdict is in. Hilton is built on a solid foundation. Despite the very real surface-level cracks in U.S. RevPAR that appeared late last year, the underlying structure of this company is incredibly sound. The evidence for this is simply overwhelming. You have record net unit growth, a massive and expanding development pipeline that all but guarantees future fee streams, a resilient capital-light model that just churns out strong cash flow, and a deep commitment to returning enormous amounts of capital to shareholders. This company is successfully doing the heavy behind-the-scenes work that's required to build durable, long-term value. The short-term RevPAR softness appears to be nothing more than a crack in the plaster, not a flaw in the bedrock. I have to concede, the case for the company's operational and structural strength is compelling. The foundation really does seem solid. But that brings us to the final and maybe the most important question for you, the investor, to think about. With such a clear forward-looking plan and this fortress-like business model, the real debate isn't if Hilton will continue to grow. It's about valuation. How much of that powerful growth story, how much of that massive pipeline, and how much of that future cash flow is already reflected in today's stock price?
The fortress is well built, no doubt about it, but is the price of admission simply too high? That's the crucial question you need to answer for your own portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.